Do you know who are the top 5 people who got richer by the stock market? Let's pop the lid on this intriguing question. Today, we're about to embark on a fascinating journey, a journey where we explore the lives of 5 individuals who have turned the stock market into their gold mine. These are the people who, with their sharp acumen and strategic thinking, have amassed wealth beyond imagination. First off, we have the financial wizard John Paulson, a man who made billions during the financial crisis. Then we have the legendary Warren Buffett, the Oracle of Omaha, who turned a mere childhood newspaper route into a multi-billion-dollar empire. We also have James Simons, a mathematical genius who cracked the code of the stock market. And finally, we'll dive into the life of Ray Dalio, a man who started his investment firm in a 2-bedroom apartment and turned it into one of the world's largest hedge funds. Stay tuned as we delve into their fascinating journeys. First up, we have John Paulson, the man who made billions from the housing market collapse. Born and raised in Queens, New York, Paulson was neither born into wealth nor did he stumble upon it overnight. His journey to becoming a billionaire began with a simple interest in business, which led him to pursue his MBA at Harvard Business School. After graduation, he dipped his toes into the world of finance, working at Boston Consulting Group and Bear Stearns. Yet, it was Paulson's audacious bet against the housing market that catapulted him into the financial stratosphere. As early as 2006, while most were reveling in the booming housing market, Paulson saw a bubble ready to burst. He created a hedge fund, Paulson & Company, specifically to bet against subprime mortgages. Little did the world know his foresight was about to pay off in a big way. When the housing market collapsed in 2008, causing an economic crisis, Paulson's fund profited immensely. His contrarian bet against the subprime mortgage market led his firm to earn a staggering $15 billion in a single year, and Paulson himself pocketed nearly $4 billion. It was a windfall that made him one of Wall Street's wealthiest men overnight. Yet, Paulson's strategy was not just about betting against the market. It was a calculated risk, based on meticulous research and a deep understanding of the market dynamics. He didn't just gamble, he made informed decisions. And even after the housing market collapse, he continued to make shrewd investments, further growing his wealth. John Paulson's journey is not a tale of luck. It's a story of strategic thinking, of understanding the market, and of taking calculated risks. It's about recognizing opportunities where others see only threats. And it's about having the courage to act on your convictions even when the whole world thinks you're wrong. Paulson's story is a testament to the power of strategic, calculated risk. Next, we dive into the life of Warren Buffett, the Oracle of Omaha. Born in 1930, Buffett's journey is one that inspires millions around the globe. From selling chewing gum and Coca-Cola bottles as a child to becoming one of the world's richest people, his story is a testament to the power of perseverance and the love for numbers. Buffett's passion for investing sparked at an early age. At just 11 years old, he made his first investment, purchasing shares in a company called Cities Service. This early experience taught him a lesson in patience, a virtue that would later become the cornerstone of his investment philosophy. Fast forward to the 1950s, Buffett discovered the concept of value investing while studying under Benjamin Graham at Columbia Business School. This method, which involves buying stocks that appear underpriced by some form of fundamental analysis, became the backbone of Buffett's investment strategy. Buffett's approach wasn't about making quick money. Instead, he focused on companies with strong fundamentals, a solid business model, and the potential for long-term growth. His decisions to invest in companies like American Express and Coca-Cola during their low periods are prime examples of his strategy at work. In 1965, Buffett took control of a struggling textile company, Berkshire Hathaway. Under his leadership, Berkshire Hathaway transformed into a colossal conglomerate, owning more than 60 companies across various sectors. Buffett's knack for identifying value where others saw none turned Berkshire Hathaway into one of the most successful investment vehicles in history. Despite facing criticism and skepticism along the way, Buffett remained steadfast in his approach. His resilience paid off, as today his net worth is estimated to be well over $80 billion. Buffett's journey shows the power of patience and long-term investing. His story is a reminder that in the world of investing, it's not about timing the market, but time in the market. So, as we navigate our own financial journeys, let's remember the wisdom of the Oracle of Omaha. Our favorite holding period is forever. Now, let's explore the journey of James Simons, a mathematician turned billionaire. Born in the early 1930s, James Simons was a curious child with a knack for numbers. His fascination with patterns and sequences led him to a thriving academic career. He taught mathematics at the Massachusetts Institute of Technology and Harvard University, and even cracked codes for the United States Department of Defense during the Cold War. But the world of academia wasn't enough for this math whiz. He yearned for something more, something that would marry his love for numbers with his drive to make a real impact. In the late 1970s, Simons founded Renaissance Technologies, a hedge fund company that would revolutionize the world of finance. Renaissance wasn't just any hedge fund, it was unique in its approach, relying heavily on Simons's mathematical prowess. The fund used quantitative investing, a method that uses mathematical algorithms and computational models to predict market trends and make investment decisions. Simons' quantitative investing was a game changer. It eliminated the human emotions and biases that often cloud investment decisions, focusing solely on cold, hard numbers. His approach was innovative and highly successful. It allowed Renaissance to predict market trends with uncanny accuracy, reaping huge profits in the process. Simons' journey wasn't without its challenges, though. He had to convince the finance world that his mathematical approach was viable, and he faced stiff competition from traditional hedge funds, but Simons was undeterred. His belief in his methods and his commitment to innovation paid off. Today, he is one of the wealthiest individuals in the world, with a net worth in the billions. Simons' story is a testament to the power of innovation and unique approaches. He saw a gap in the market, filled it with his mathematical genius, and reaped the rewards. His journey shows us that success in the stock market doesn't always come from traditional methods. Sometimes it takes a mathematician with a love for numbers and a desire to make a difference. Simons' story proves that unique approaches and innovation can lead to massive success in the stock market. Finally, we profile Ray Dalio, the founder of the largest hedge fund in the world. Born in a middle-class family in New York, Dalio's fascination with the stock market began at the tender age of 12, when he bought shares worth $60 in Northeast Airlines, which tripled in value. This early win sparked an interest that would shape his life. Dalio's academic journey led him to earn an MBA from Harvard Business School, a stepping stone that would pave his path into the world of finance. But it wasn't an easy start. After being fired from his job for insubordination, Dalio was at a crossroads. It was this moment of adversity that led him to found Bridgewater Associates, right from his two-bedroom apartment in 1975. Bridgewater Associates, under Dalio's leadership, grew to become a powerhouse in the world of hedge funds. However, the secret to Dalio's success wasn't just his deep understanding of the market, it was his principles-based approach to investing. Dalio believed in radical truth and radical transparency. He fostered an environment where the best ideas won, no matter who they came from. This unique culture, combined with his investment acumen, is what set Dalio and Bridgewater apart. One of Dalio's key decisions that led to his success was his bet against the U.S. housing market before the financial crisis of 2008. It was a contrarian move that paid off handsomely, earning Bridgewater huge profits and solidifying Dalio's reputation as a visionary investor. Dalio's journey is a testament to the power of a strong investment philosophy and principles. His story teaches us that success in investing isn't just about understanding the market, it's about having a clear set of principles, being willing to go against the grain, and creating an environment that fosters open dialogue and the best ideas. Dalio's journey is not just about financial success, it's about the creation of a unique philosophy that continues to shape the world of investing. So these were the top 5 billionaires who made their fortune through the stock market. Each of these financial titans, John Paulson, Warren Buffett, James Simons, and Ray Dalio, have shown us that patience, persistence, and a deep understanding of market trends can lead to incredible wealth. They've proven that strategic investing isn't a game of chance, but a calculated endeavor that requires constant learning and risk management. Despite their different strategies, they all share a common trait: an unyielding commitment to their craft. This isn't to say that they didn't face setbacks. Quite the contrary. Each of them has faced considerable challenges, but their resilience and unwavering belief in their strategies have helped them to overcome those hurdles and reach the pinnacle of success. Remember, the stock market can be a powerful tool to build wealth. Do like, share, and subscribe if you enjoyed the video and want to learn more about investing.